Welcome everyone to the Withum Real Estate Roundtable. We've got two separate presentations for you today. The first one will be on the subject of cybersecurity and how it can affect your business. We will have some polling questions on that that will again help direct our discussion. But at this point, I'd like to introduce our first speakers. Our first speakers are Eric Jackson and Manny Capello from the Withum Cybersecurity team. There's Manny waving. Both gentlemen are former military, former DoD, really cyber geeks. I've spoken to these guys quite a bit. They are rather impressive and quite frightening, honestly, to talk about how people can get into your systems and what happens once they get in. So it is 12:03, so I will get us going. So I don't know if Eric or Manny will speak first, but I will turn the floor over to each of you to discuss the risks that real estate entities face and some things to consider and be mindful of. So, gentlemen.
All right. Thanks for the introduction, Alfred. My name is Eric Jackson, VCISO for Withum Cyber. It's basically a strategic security expert. My background is, as mentioned, I spent a lot of time DoD doing security work, both offensive and defensive, securing DoD networks and attacking DoD networks with authorization. I guess, Alexander, do you want to throw up our poll questions? We can start it off.
Sure, we can do that.
Yeah. Okay.
So remember, menti.com, the code is up there. Do you have a security program in place? Good, so far most people do, that's great. And some people just aren't sure, and that's okay too, but hopefully after this meeting, you'll give it some further consideration. All right, so I think we have a good sense there. Mostly yes, but some are unsure, and that's okay. All right, Eric, do you want all the questions right up front or as we go?
No, we'll do. I'll talk through, so we can talk through this.
Sure. Okay.
So this is our favorite starting question, and whomever we talk to, we always ask, do you have a security program in place? We find a lot of companies may or have something very cursory that they say, yeah, we have security program. We think our IT guys installed antivirus, whatever the case is. We're finding more and more, and something we always like to point out is that hackers need to be thought of as business competitors at this point. It falls in line a lot with the old Scorsese movie idea of a protection racket, but it's the idea that whatever you're making money off of, they're either going to block your ability to make money or steal your money. And these attacks are pretty agnostic to industry, but we're seeing more and more attacks where people wouldn't expect them. Real estate being a great example. Property management firms that deal a lot in ACH transactions or direct transfer funds, and also have tons and tons of data related to mortgages and property values and trade secrets. All these things are big, juicy parts for hackers to attack and go after. We were talking through attack scenarios, Mac and I, and we, like I said, with the competing business model, they want to make it so that you pay them to continue to function as a business. And we were talking about, wouldn't it be incredibly effective if on the 29th of the month, I launched an attack that shut you down so that by the first of the month, you couldn't receive or transfer funds. In the sake of the real estate market, that would, according to what I've heard talking to real estate professionals, would be really, really bad. And not something that is out of the realm. People can do things like that. They do. We see more and more that attackers are starting to target the niche and then look at how they do business. And they'll sit there for a while collecting intelligence, figuring out what the business does, and then launch at the worst time humanly possible to get you to pay up so that they can make their money. Do the second polling question, Alexandra?
Hey, remember mentee.com? Okay. How concerned are you about hackers attacking your business? Okay, so far middle of the road. We got some people really concerned, which is unfortunately a good thing. You should be concerned, but a fair amount of people still saying they're not sure how concerned they should be. So, Eric, I think that's what we need to impress upon people. How serious this is, and how concerned should they be?
Absolutely. Mac, would you like to discuss how concerned? Mac, in addition to everything, I was introduce myself. Mac runs our intelligence program, so one of his major jobs is figuring out what current threats do, how they work, and what they're targeting currently.
Yeah, to those who are preparing for an attack as we speak, I think you're really probably right in the right spot. One of the things that we've noticed over the last couple years, even before COVID has kind of really just hit it with some juice. But we've seen the hackers kind of work in this spiral fashion where they move from industries that have caught up to their shenanigans and improved their security to industries that have not. Healthcare is kind of right in that spot where they're starting to put a lot of investment into cybersecurity beyond their typical regulations that they have to follow, like HIPAA. And hackers are still being successful there, but they're also expanding their scope of their attacks to include, say, the auto industry and the legal industry and the real estate industry, because these are industries that have not been under attack, so therefore have not invested a lot of money in security and are being seen as soft targets. So if you're in the I'm preparing for an attack as we speak, you're probably going to be putting yourself in the good position to be in to thwart some of these attacks. And that's probably the best mindset to be in. If you wake up drenched in sweat most nights, there's a good chance you are so concerned with security that you don't take time to think reasonably about to think reasonably about who you're going to be dealing with security. And wherever there's money, there's always scammers, right? So you want to be careful not to just to throw your money away to thinking you're getting security. You want to deal with reputable companies who have deep experience and deep skill, and don't let anybody scare you into getting security. You want to step into the idea of getting security with a good amount of concern and being prepared for what's coming. And so the hackers are coming, but you don't want to just throw your money away either. So I think you're in a good spot if you're I'm preparing for an attack as we speak. And really the attacks you need to be worried about are phishing attacks and ransomware attacks, because that is the primary means that the hackers they're coming at you. Remember, they have a competing business model to yours, and they want to prevent you from making money so that you're incentivized to give them money so that you can get operational again. And so even if you don't think that you have something that's worth stealing, they're not necessarily thinking about it that way. They're thinking about making sure you can't operate so that you're willing to pay them so that you can.
Perfect. Can we get that next poll question? I think it's the right one.
Yeah, that was a great lead in for our next one. Remember, mentee.com, MENTI. Okay. If you lost access to all of your computers, could you still conduct business? And that's really what we're talking about with ransomware. It's not so much taking your data and using it for an illicit purpose, but preventing you from conducting your business. Okay,
and
we
so
are
this,
having a varied response, Eric.
yeah, and that's not unexpected. We, as we mentioned, we spent a lot of time in DoD, and it was realized as cyber was becoming more and more prevalent, cybersecurity is becoming more and more prevalent. It was realized that we were having a hard time in the DoD doing our work without computers, and it became a major driver was to go back to what we used to call the chalkboard, where you basically did all the work on a chalkboard and a whiteboard, and we took away all your computers. And that's actually where Mac and I started doing our security work, was depriving the military of their computers and seeing what they could do as far as the rest of the mission went. That brings in an excellent point here, where I saw a lot of yeses, nos, and partialies. It's a question that you need to think of as we talk about you're preparing for an attack, is no matter how good your defense is, there's a chance you're going to get caught out, and you need to be prepared for what happens if you do. The smaller your business is, there's a interesting place, and we talked about, yes, I'm developing a security program, and that's great. The smaller you are, the better the timing is, because at that point you do probably still have the dynamic posture of being able to shift off of your computers and do business without them. But as soon as you grow past that, there's going to be a point where the partially becomes the answer. If I get compromised, all my computers are taken down, I can kind of do business, but I'm going to have to do a lot of stuff to get that back to normal operations. We see the average turnaround for a mid-sized company getting compromised is about 14 days of loss of business, 7 to 14 days that they are not operable. We like to always highlight that, and business continuity plan and disaster recovery plans are part of cybersecurity, and they should always be considered as you're talking through what I'm worried about. And we talk about the competitive model. We like to beat that into people's heads to understand about cybersecurity, is that everybody on this call worries about their competition. And that's what cybersecurity is now, is that your hackers are also competition. So you need to think, if we're hacked, what happens? And when they come for us, how do we stop them? And then along those same lines, something we always point out as well is that your IT guy, whoever that may be, for lack of better terms, the people who maintain your IT are generally not your security people. They are more than adequate to do your IT, but you do need a healthy external view of your security program. Somebody that is not part of your organization to look at it and act as a bad guy would, and work through your program to determine where your weaknesses are. And again, the smaller you are, the cheaper and faster that is, and the more developed your program is, the better. I think we have one more polling question.
We do, and it's a great one, what you just spoke about, Eric. You know, your IT person, call it your network engineer, what have you, might not be the best suited for a security analysis. So the question is, have you ever been assessed for security risk by a third party? And it's one of my favorite questions. I love the options here. Have you ever been assessed for security risk by a third party? Remember, menti.com, MENTI. I was gonna say, do we need a refresh? I think, yeah. Here they come. Okay. Oh, interesting. So far, a fair number of people have not. That sounds like exposure to me. And of course, my personal favorite, my cousin Steve looked at it, he said it was fine. I love that. Again, Steve, while he might know IT, might not know security. And again, the gentleman is speaking, this is what they do. They play the bad guy. They would behave as though a bad guy would to get in and access your data. And we see, again, close to 2/3 of us have not had this risk. So, Eric, what does that mean for people?
So, Mac, do you want to talk about it? Because Mac,
oftentimes, people might compare or analogize going to the doctor to get a regular checkup. Like, you should do that just to see if anything is wrong. And there is some, there is some value in creating an analogy like that. The issue with the analogy where it falls apart is with cybersecurity, everything is fine until you get hacked, until somebody comes in and they phish you and you get ransomware, and then it's too late. And then you got to spend a bunch of money to deal with the ransomware. Even if you don't pay the ransom, you guys still got to clean it up. Or you have some kind of event where you lose all your data. It doesn't even have to be a cyber attack. It just could be a natural disaster or something like that. You lose all your data. You didn't have any backups, or your backups are corrupted. So unless you had somebody come in and assess, and these are the kind of things they're going to assess. They're going to assess your weakness to an attack. They're going to assess your weakness to a natural disaster. I mean, they're not going to go in and create an earthquake, but they can sit down and they're trained in these ways, or they think very differently than a lot of people in these ways, and they can help you assess your ability to protect yourself against cyber events or natural disasters, and recover from in the event that one of them happens. And if you don't have a plan, what's the old adage? If failing to plan is planning to fail. If you don't have a plan, you have no idea what's going on. If you do have a plan, then you need to test it. And part of the way to test it is to have a third party come in and assess the plan and run through scenarios and pretend to be a hacker. You do it in a safe environment where if things go wrong, you're not going to get hurt, but you have found the issues, and now you can fix them. Eric, I'm sure you have plenty to add.
Well, you hit almost all of it on the head. I mean, the point of a third party is, and Al said as well, is you need somebody who is as capable as a hacker to look at your network assessment. Steve, cousin Steve, is certainly, he may even have a security background, but we talk about tickling yourself, and it's impossible for you or your IT people or even your own security people to identify the problems they've created. And that's just human nature, right? We are all capable. It's no matter how many times you proofread your document, there's going to be a typo in there you keep missing. And this is no different. Hackers exploit those typos in a security landscape, right? They look for the smallest little problem and exploit it and turn it into a major, major problem for you. So I think the operative points, if there's something to take away from this, is if you don't have a security program, get one going. And even if it is purely rudimentary, where you start reading about it because your company's too small to afford these kind of things, it always helps to bring in a third party, even if it's just for a very quick consultation to talk through what you need. It's something worth addressing. Also, when you look at it, whenever you look at it, you say, okay, I am secure. I have done this. I know what I'm doing. Get somebody in to take a look at that. Have that assessed, because guys like Mac and I, but who aren't on the good guy side, look for those small typos, the flaws that you're going to miss. And so it's always good to have somebody take a second look at that kind of thing. And more than anything, and I think we've talked about this, is don't people think this is going to be prohibitively expensive, security, and that security should be a dedicated part of your budget, part of your IT budget. But also don't let that scare you off from at least approaching it at the very beginning. We want everybody to be secure. It makes life better for everybody. It makes our jobs a lot easier when there's not problems we need to respond to. So with that, I think we've pretty well addressed cyber. Al, any questions from you or from the crowd?
Yeah, well, just a kickoff question, and I will invite others to ask theirs as well. You can either type it into the chat box, or you can raise your hand. We'll try to identify you, and then just unmute yourself. But my first question would be, are there any stats out there about the cost of a proactive preventive test versus the cost of recovery after you've been hit? I've got to figure it's a multiple.
There is. So and this is going to get really, really general.
Right.
Generally, we look at the statistics we use is 8% of your revenue should be your IT expense, and 10% of that expense should be your security expense. We generally work within those boundaries when we're talking about consulting, and most firms do about the same. When you experience an attack, It varies wildly at that point, but we've seen it go as high as 40% of the revenue. From the cost of lost business, your intangibles, your lost business, your man hours for recovery, as well as paying a ransom. We saw a ransom recently for a relatively small company, about 25 people. It was $1.2 million to pay the ransom, which was a significant portion of their annual revenue. And they honestly had no choice. All their financial data for the last 7 years was gone. All their client data, their client relations management, all of it was gone. They had very little choice. So when you look at it, it's exponentially larger to do it after the fact than it is to do it during.
I certainly would have thought so. And, and for the benefit of the real estate people on the call here, I would imagine a cost like that is not escalatable. So that's one you're going to eat. For Eric and Mac, escalatable means you can charge back to the tenants. I don't think you can charge this back to the tenants.
No.
Yeah, in the end, you're really trying to reduce your risk, right? The way things are going now, especially with AI having entered into the scene, okay, artificial intelligence, this is no joke, right? If you put a server out on the internet, it will be touched by a malicious hacker probably within 8 minutes. And now they're not attacking necessarily, they're just doing discoveries, right? They just want to see what is out there, and they have maybe some simple stuff to see if you've used like a default password, right? Like you didn't change the manufacturer's password, you put it out there. You're like, I just want to get out there. There's a good chance if that's what you did, somebody's logging in who shouldn't be logging in. But with they're building these bots, and what they do is they just constantly go out on the internet and they look for new targets. And they have a select, cache of tools or weapons, whatever you want to call them, and they just throw them against the targets. Boom, they just start throwing them against the targets, and they see what works. They see what sticks, right? Because they got other things to do, right? They got families, some of them, they got pets they want to take for a walk. They don't want to sit on a computer 24 hours a day. So they automate all this stuff, and AI is making it way easier. So the risks of getting attacked are going up. So you want to spend a little bit of money to reduce that risk so that when you get attacked, you're not the guy who had his front door open because you didn't think there was anything, you didn't think somebody wanted that couch with duct tape all over it, right? So like what Eric said, if the standard, like you spend a little bit of money to reduce the risk, about 8%, and there's a very good chance, because that's really what we're talking about, right? Probability. There's a very good chance that at 8% that you're spending is preventing you from having to spend 40% of your revenue to deal with the problem later.
Yeah, very, very well said. Thanks, guys. And again, particularly, cyber risk has always been there, but for me, it has become even more prevalent now, particularly with the remote work, remote file access, and so on. So you've got 20 employees accessing remotely. Well, guess what? That 21st one could be knocking at the door too. So I think now more than ever, the idea of security risk is very prevalent and should be addressed. So of course, feel free to reach out to any of your Withum contacts who all, have a direct line to Eric, to Manny, to their whole team. Should anybody have any questions in that regard. But thank you both, Eric and Manny. Very informative, very helpful. And thank you. So, right. So let's shift gears here a bit and stop scaring everybody and talking about money going out the door. Let's talk about ways we might get some money in. Our next speaker is Matt Walsh, a senior manager here at Withum. Among other things, a member of our SBA team, who for the last 10 months or so has been one of the most popular people in the firm. He'll have some discussions on the latest stimulus bill and as well as the PPP loans, both prior and current. So I think actually for this, Alex, if we could put all these questions up, there's 3 questions. Again, they are menti.com, MENTI. The code for those that didn't see it is 2029629. And the first question, very simply, is: did you obtain funding from the first round of loans? And, we understand, the real estate entities themselves may have the issue of not having employees, but perhaps through a management company, you were able to get some funding. But if you had your own cleaning staff, support staff, great. Okay, so sort of a mixed bag, but a fair amount do or did get funding, which is great. Okay, so some yes, some no, but about middle of the road. And yeah, not eligible. We certainly understand that. Okay, next question, please. So if you did receive a loan in the first round, have you applied for forgiveness yet? Okay, someone has applied, some not yet. And how does one apply for forgiveness? Well, generally speaking, it's through your lender. The lender will have an application process for the forgiveness. I actually just received word this morning, Chase Bank is now accepting applications for forgiveness for round one. But this is pretty much what I expected. Matt, I think you'd probably think the same.
Yep.
And lastly, our final question, if you would, please. Will you be applying for a second round? And again, this isn't sure. This doesn't matter if you did apply for the first round or not. They are independent, though related. They are independent. And again, not sure. Well, hopefully you're in the right place and you'll hear more about it. Yes, there are a few more restrictions on the second round because the last time was prospective. Now it's more retrospective, and Matt will run us through that. So again, sort of a diverse answer here, but certainly some are and some aren't sure. So for those that aren't sure, you should most certainly listen up here. But Matt, I will turn it to you. Matt, what can you tell us about the latest bill that was passed?
Sure. So thanks, Al, for having me. I hope everyone's doing well. Happy New Year. The Consolidated Appropriations Act, which was long since talked about, right? The first kind of wind that we received about this bill is really going back to August, right? It took Congress some months to come to a position where they agreed on the main provisions, and ultimately, as we know, it was also ended up being attached to government appropriations bill. So it was a nice round number of around 5,600 pages of information. So the Consolidated Appropriations Act made some fairly sweeping changes to the PPP program. It made changes to tax credit programs. It made changes to tax provisions, right? Just stuff that was expiring that changed. But certainly the highlights surround the Paycheck Protection Program. So what the Consolidated Appropriations Act did was it reopened the Paycheck Protection Program that was initially available. It made some changes that apply to some borrowers, and then most notably, it created a second tranche of funding. Right. So when we think about dollars are important here, right? So what CAA did was it took $284 billion and assigned it to the Paycheck Protection Program to reopen, right? Just to give you a comparison to what that was from how that compares to the first program. About $500 billion went out in Paycheck Protection Program number one, and that $500 billion includes all loans issued from April 1 through August 8th when the program had officially closed. Right. So I for those of you out there who answered no, I did not get I did not get PPP1, the CAA did reopen the first Paycheck Protection Program, and it did so for a couple different situations, right? So there were borrowers, there was a lot of confusion, right? Everyone remembers what it was like in April, right? There was a ton of confusion around who was eligible, who was not eligible, how to calculate payroll costs, how to calculate loan amount, and the one thing that that it seems as if got to Congress members is that, look, a lot of small businesses didn't get the amount that they should have gotten in the first round, and it's not fair to those businesses to not have been made whole. So what the CAA did was it took, of that $284 billion, it took $35 billion, and it said, all right, we're setting $35 billion aside for borrowers who either, one, were not able to take advantage of PPP1, so if they did not apply originally, they could now go and do so, right? And two, correct the wrongs of those people who didn't get the amount they should have, right? So if you find yourself in a situation where you weren't able to include certain, if you're set up as a partnership and you weren't able to include compensation for the partners, you can now go back and add that in. If you were in a situation where you became eligible, or you were eligible for, let's say, $2 million, but you looked at the program and said, there's no way I'm going to spend that in 8 weeks, right? So I'm just going to take $1 million, right? You could go back and get those funds. If you are in a situation where you got that $2 million and after 4 weeks, right, all of the guidance around the FAQs came out and who should and shouldn't get it and how they're going to spend it and how they're going to audit everybody, and you said, well, you know what, I got to give this money back. I don't think I'm going to spend it, so I'm going to give it back. You can also go back and apply to get those funds, right? So that's the extent of what it did for PPP1, right? People who didn't receive the funds the first time around could go now apply, provided that they meet the eligibility criteria, right? And people could upsize their loan amounts if they didn't get the right amounts. So then what it did was it created a second program. We affectionately call it PPP2. Some people call it PPP3. You can refer to it however you like, but it is a second program, right? And it is now the specific term that the legislation uses is called second draw PPP loans, right? And they call it second draw PPP loans because you have to have gotten a first draw in order to get a second draw, right? So when Congress was going down this path, right, and many of you probably remember, a lot of the headlines about the news were how there wasn't enough funding to small businesses that were particularly hard hit, right? The smallest of businesses in the country that were the most hard hit were shutting down left and right. The 8 weeks of funding was not enough. 10 weeks of funding really was not enough. So they really wanted to target a second draw PPP loan towards the smaller program, towards the smaller businesses, and they did just that here, right? So when they pulled in the second program, they said, okay, well, let's talk about eligibility from a second program. They said, all right, well, starting point is you had to have gotten to PPP1, right? You had to be eligible for the first round to get the second round, right? From there, we allowed small businesses who had 500 employees or less receive the PPP1. Well, we want to target this towards smaller, so they dropped that 500 down to 300. They also wanted to make sure that this was going to the particularly hardest hit businesses. And because of that, they instituted a 25% gross receipts reduction. So you have to have suffered a 25% gross receipts reduction in order to be eligible, right? So there was a lot of questions around what gross receipts are. And the SBA last week came out and identified that gross receipts are essentially the way in which the entity keeps their books. They would use revenue, and it would include things for like allowances, and the overall gross receipts kind of lines up with the way that each company takes their revenue. So there is that limitation as well. The other thing they did that is notable is that they took out the ability for borrowers to qualify under the alternative size standard, and what that means is there was the ability for a company to apply regardless of how many employees they had, provided that they met a tangible net worth and net income threshold from the first time around, and they pulled that out, right? So they really wanted to target this to the smaller businesses. The other thing that they did was they capped the maximum loan size amount at $2 million as opposed to $10 million. So for most companies, the calculation to get the loan is going to be largely the same as the first time around, right? It is 2.5 times your average monthly payroll costs. The definition of what payroll costs are now are well defined, right? We have plenty of documentation to tell us what exactly is a payroll cost and what exactly is not. So we expect that borrowers will be able to clean up their calculations, make sure they get the right amount, subject to a cap of $2 million. When we look at across affiliated groups, right, from the first program, there was a $10 million cap per entity and a $20 million cap per corporate group. That number's dropped down to the proportion stays. So $2 million per entity, $4 million per corporate group. Right, so that's just a general level of overall eligibility when we talk about the PPP and what kind of amount that you could consider. So one of the questions that I just saw in the chat says, does revenue include federal grants received? So PPP1 loan is excluded. So the difficulty here is that we haven't received any guidance around whether or not other grants can be excluded. Right, it does say the definition of gross receipts indicates that any PPP loan forgiven would not be includable, right? Because they don't want that to throw a company out of eligibility, but it does not indicate that you can exclude other grants specifically. It just says all gross receipts received or accrued in accordance with the company's accounting procedures. So I would tend to think that those would be included, but I'm hoping that something comes out that says, look, we understand that many companies received assistance from various federal agencies as a result of COVID, and none of that stuff should be included from your gross receipts review. But right now, I don't have anything that I can point to that says that. Perfect, thanks. The other thing that that this legislation did with regard to the PPP is it did expand the rules for what is forgivable and what is allowable uses of the funds, and that will really come into play here with borrowers who are trying to borrowers who weren't necessarily able to get full forgiveness from the first program, even with the 24 weeks, which was the case for some particularly hard-hit businesses. But two, it will be important for those borrowers of the PPP who are trying to maximize their benefit from the different federal programs, right? So some people received grants that they can't double dip on. Some people will be interested in potentially taking advantage of the employee retention tax credit, which I'll talk about in a few minutes here. But the expansion and the changes to the program that they made overall from a cover period perspective and eligible costs really centered around making the program more accessible and able to get full forgiveness for more people. So here's what they did. And by the way, these changes that I'm about to talk about, they're relevant for borrowers, for all of the group that answered no to the question they hadn't yet applied for forgiveness, and also borrowers who received PPP2. Right. So what they did was they allowed a sliding scale for the covered period. They redefined the covered period. Previous to the CAA, the covered period was one of two things. It was 8 weeks or 24 weeks, right? There was no middle ground that was offered to a borrower. There was a slight administrative convenience that was offered that allowed borrowers to apply in the middle of their covered period if they finished, but nothing really allowed you to say, okay, I'm using, within the legislation, I'm using 14 weeks, that's all I need, I'm cutting it off, I'm done, right? That has now changed. The CAA has said, look, the borrower can choose their covered period anytime between 8 weeks and 24 weeks. So if you want to use 11 weeks, you use 11 weeks. If you want to use 16 weeks, you use 16 weeks. The key is that what it also does is it keeps that $100,000 proration rule, right? So if you are looking to prorate if you're looking at your covered period and you're saying, I'm using 11 weeks, you have to prorate on a weekly basis using 11 weeks. You wouldn't get the full 46,000 that you would be otherwise eligible for under each employee. You would take the 100,000 divided by 52 multiplied by 11. So you do need to take that into consideration when you're thinking about cutting off your covered period. The other thing that it did was it expanded the definitions of both payroll costs and non-payroll costs.
Matt?
Yes.
Before you move off covered period, I guess it's a nice matter of convenience to choose your period. But why would an entity not just use 24 to get to get the biggest amount? So even if someone's kicked out, they still have some leeway. Why would you not use 24?
Well, there's really two reasons. One of which is that if you use a covered period of say 11 weeks, you can apply earlier, right? You don't need to wait until 6 months later, right? The second reason, which is something that I'll talk about a little bit more after we get through this section, is if you are looking to maximize your benefit between a PPP loan and another program that the company may be eligible for, then you can't double dip on expenses between federal programs, right?
Good. So we can talk about that then. Sure.
Yeah. So we'll definitely talk about that.
Great.
As far as the changes to payroll costs and non-payroll costs, the payroll cost definition was slightly changed, and it was something that we had all kind of presumed, but was never actually written into law. Was that payroll costs now include group term life insurance, vision, and dental benefits. It was something that the SBA had said, look, we understand this should be included. We get it. You're okay to include it. But it was never written into the law. So they wrote it in. That's the only change to payroll costs. They also kept the requirements that you have to spend at least 60% of the proceeds of the PPP loan on payroll costs, right? So that 60-40 split still exists, right? Non-payroll costs, however, they expanded quite a bit, right? So they are now allowing borrowers to add on to their non-payroll costs 4 new groups of expenses, right? So the first group of expenses is covered operations expenditures. So this was an area where we had received a ton of questions from borrowers who had received the loan and wanted to know, could I spend it on costs to my payroll provider? Can I spend it on software costs that I need to run my business? And the answer was, unfortunately, no. But they've now expanded that. So covered operations expenditures includes any software costs that are essential to running the operations of the business, right? So in theory, all of the payroll costs, so what you pay your payroll provider to process payroll, what you pay for any of your back office softwares, stuff like that. Anything that's essential to the business is now included as a non-payroll cost. Then a next category is covered property damage costs. So if there were property damage or vandalism related to public disturbances during 2020 that were not covered by insurance, these are also now part of those non-payroll costs. The third section is covered supplier costs. So this is mainly directed at companies who have contracts to purchase supplies that are essential to the business, right? And that there were contracts in place when the money was received for the PPP that had to be honored, right? So if you had a contract in place to purchase supplies, I don't think this is particularly relevant, so we won't spend too much time on it. But if that was in place and you needed to pay for it during your covered period, you could include that. And then finally, one that is relevant to almost all companies is that they now included worker protection expenditures. So if you had purchased PPE, right, to keep your employees safe when they had to be in the office, that is now included as a non-payroll cost, so part of that 40% bucket, right? And by the way, there's a fairly detailed list, and the worker protection expenditures does include certain capital expenditures. So if you had to retrofit your office, if you had to add air filtration systems, so some of those would be included, and there are certain other capital expenditures that could be included. So again, PPP1 borrowers who haven't yet applied get this expanded ability, and then PPP2 borrowers will also have it. I'm going to pause and just see if there's any questions with regard to any of the things I just talked about. I know I just said a lot of stuff, right? I normally would do this presentation in about an hour, and I just kind of crammed it in here. So I do want to pause and see, does anyone have any specific questions? I'm happy to answer them.
Right. So far, Andrew's saying he agrees grants probably should be included. So how about safe harbor number 2? You have that there, Matt?
For PPP loan 1, any reductions have to be restored. Was this changed in any day? Yeah, I do. So I haven't seen any update to the applications, but I do believe the date will move on this, the date that they have to be restored. Generally speaking, though, one of the things that we've been seeing a lot of is, and this is something that, as part of our review of when we help assist clients with the loan forgiveness side, we see a lot of calculations that lead to a salary reduction or a wage reduction penalty. And I think it's important to keep 2 things in mind when you're looking at that. The first thing to keep in mind is that any reductions, whether they be FTE reductions or salary and wage reductions, they're applied on your gross eligible spend, right? So if in fact you're in a position where you're using a 24-week covered period and you've spent 2.5 times your loan, right? Any reductions apply on that gross amount, right? So if you're spending 2.5 times your loan, even if you have a 10-20% FTE reduction or a $50,000 salary and wage reduction, ultimately you're still going to be asking for full forgiveness. The other thing that I'll say with regard to especially these salary and wage reductions is that you have to be careful because a lot of the stock reports from payroll providers will spit out a quote unquote potential salary and wage reduction, and they'll say it on the bottom. On the bottom, you know, there's a big, you know, box that talks about how it's calculated and how this is really just a starting point, and you need to make sure that there's a salary reduction. And here's the rule. The SBA clarified this, that the only time that you would have a salary and wage reduction penalty is really to the extent that a reduction in somebody's total pay did not relate to a reduction in FTE. And here's what that means. It means that if you have an employee, let's say you have an employee that was making $1,000 a week, right? And they were working 40 hours a week. And because of the pandemic, you had to say, look, I can't pay this person $1,000 a week anymore. So I'm going to ask them I'm going to pay them $500 a week. And instead of making them work 40 hours a week, I'm going to make them only work 20 hours a week. What happens there is you had a proportional drop in the FTE, right, and the salary, right. So the rate that you were paying them did not change, right. You said, all right, you were working 40 hours, I was paying you 1,000. Now I'm going to ask you to work 20 hours, and I'm going to pay you 500. That doesn't represent a salary reduction. What that represents is an FTE reduction, right. So, you know, whereby that person was a 1.0 for an FTE previously, they're now a 0.5. Provided that you kept that proportional relationship between the hours that they were working and the rate that they were making, you do not have a salary and wage reduction. Under the same example, a situation in which you would have a salary and wage reduction is you said to an individual, look, we can't pay you. I still need you to do your full job. I still need you to work 40 hours a week, but I'm only going to pay you $600 a week, right? And in that circumstance, they're continuing to work 40 hours a week. You've reduced their pay by more than 25%, and you would have a salary and wage reduction, right? And again, that would then be subject to the safe harbor rule, where you could restore that salary and not be penalized. But it in most circumstances, what we're finding is that borrowers really fall into that category where they had a proportional reduction in the ask of the worker as compared to the reduction in the actual salary or wage rate.
Right, great, thank you.
Any other questions on the PPP? I do want to allocate some time here to the employee retention tax credit, because I think it's a good thing to talk about.
Definitely. Go ahead.
All right, perfect. So the other thing that is sort of big news here for borrowers is the employee retention tax credit. And the reason this wasn't as big news in the first sort of over the last 9-10 months or so is because there was a bifurcation in the law that said, look, you get the PPP, you can't get the ERTC. It's one or the other, right? So most borrowers who received the PPP just kind of pushed this out of mind as if it's not a possibility, because it really wasn't. But what the CAA did was it said, okay, now borrowers can get both the employee retention tax credit and also the PPP. Which is nice, right? And similar to the PPP, the CAA also created two separate programs, right? They created the pre-2020, the 2020 program, pre-January 1st, 21 program already existed, and it made some slight tweaks. Then it created a program for Q1 and Q2 of 2021. Right. So first I'll talk about the program in 2020, because really the only change to that program was that you can now claim it if you got the PPP. The only rule is you can't double dip. So you can't use wages that you're using to get forgiveness on PPP towards an employee retention tax credit. But what the employee retention tax credit says is that in 2020, right, and this is for the 2020 period only, between March and December, if you had either a precipitous drop in revenues, which is defined as 50% in a quarter as compared to the same quarter, or you were forced to partially or fully suspend your operations, you could be eligible for a credit for keeping your people employed, right? And the calculation of the credit depends partially on the number of employees you have, and then partially on the types of wages that you're paying. So if you meet the gating criteria of a drop of 50% or more, or partially or fully suspended, and you have less than 100 employees, all of the wages that you're paying those employees would be eligible for a credit. The credit calculation would be that you get a 50% credit up to $10,000 of wages, right? So up to a $5,000 credit per person, right? If you're over 100 employees, then you only receive credit for the portion of the wages that you're paying people not to work, right? So the people that they're not being productive for you, right? They're sitting at home, they're not doing their job, but you're paying them anyway, right? So again, that threshold is important, the 100, over 100, under 100, because it could mean a fairly substantial difference. And this program, again, you couldn't have gotten it, right, if you had the PPP. So the PPP was more lucrative for most borrowers, so they went with that. The other thing that it did was it created, and by the way, that credit is over the entire 2020 year, so $5,000 total. That's all you could get. 2021, however, is a whole new ballgame. And what they did was they made this program a lot more palatable for companies who don't have as a substantial reduction, and they made the credit larger. So here's what they did. For 2021, if you have a 20% reduction in gross receipts as compared to the same quarter in 2019, we skip over 2020 because they didn't want companies who were affected by COVID to be excluded from this program. So if you have a 20% revenue reduction, you have, and then you have basically 20% revenue reduction, you could get a credit, and the credit is bifurcated by quarter now. So it's each quarter, you can get up to $10,000 per person reimbursed at 70%. So we went from a total of a $5,000 credit in 2020 to potentially getting $7,000 per quarter for quarters 1 and 2. So a total of $14,000. And here's the kicker. The other thing that they did was that 100 employee threshold that we talked about, that if you were over, you would only get credit for wages you weren't paying people to work. You were paying people not to work. Now increases to 500. So everyone under 500 employees could, in theory, provided they meet the eligibility criteria, get this credit for each Q1 and Q2 up to $7,000 per person. Again, the kicker is that there's no double dipping, right? So when we talked about earlier, there was a reason why the strategy may come into play that you don't want to use all 24 weeks of a covered period on payroll costs and payroll costs only. That's this situation, right? So if you're saying to yourself, I'm getting the PPP too, I know I'm going to have a 20% reduction, I think I'm going to meet these eligibility criteria, you're definitely going to want to take a look back. You want to take a step back and say, okay, well, how do I maximize that, right? How do I make sure that I'm keeping wages clear to give me an employee retention tax credit, keeping wages clear to cover my PPP requirements, right? And maximizing benefit for my company, right, throughout the whole period of time. Right, and that's going to be the important thing. And you know what's funny is this whole process is very similar to the way the first process played out. Only it's a little bit less frustrating because we're expecting it this time, right? In April, we expected the SBA to issue just this sweeping guidance that would indicate how we would be able to run this program, and they just didn't. They released it over time. They're doing the same thing here, right? So we know you can't double dip. We just don't know as of today the exact way in which they're going to administer the no double dipping rule, right? So there's still some gray area, but it's definitely something that business owners should be keeping in mind right now. And if you think you're going to be in a position where you may be able to take advantage of both programs, you should definitely start to consider that and start to engage with your Withum advisor, right, in those conversations to make sure that they're aware that this may be something that you can take advantage of.
Excellent, thanks. And right, and now that makes perfect sense. So you might want to use less than 24 weeks if you want the wages eligible for the ERTC.
Bingo.
Yeah. So for those that did not initially take the ERTC back in 2020, how do they go about it now?
So again, this is something that we are expecting more guidance on, but my understanding is that you can do it through amended payroll, amended 941s. It is generally run through the payroll providers. Excuse me. So the payroll providers may have a process in place to allow you to do it in your fourth quarter 941s, which will be filed shortly here, right, in the next few weeks.
Right. Mm-hmm.
Yep, this month. They may also say, you know what, we'll file it on the first quarter return. On the first quarter returns. This is a refundable credit too, right? So if the amount of the credit exceeds the amount of employer payroll taxes that you owe, you can file it's a form 7200 to get a refund.
Excellent, excellent, excellent. Thank you. Well, Matt, thank you for that. Some very, very helpful information there. And as you mentioned, though, guidance still forthcoming, but this is all based on what we
Always.
know today. It's based on what we know today. But certainly, the CAA did clarify a lot of things, all for the better. All for the better. Expanding the program, loosening regulations. The addition of covered supplier costs actually helped a couple of my clients, which is really great.
Yep.
We have just a couple minutes left. Are there any other questions out there? Any pressing questions people have? Again, you can either just unmute yourself or put it into the chat for anything you may have. Okay. Nothing just yet. So we'll hang around a little bit, but Matt, I do want to thank you very much. Eric and Mac, I'm not sure if you're still on, but nevertheless, great presentations from each of them. I'd like to thank Alex Bryan for putting this together for us. And,
so Matt, one question
okay.
can I ask?
Sure.
That 941, my understanding is you're right. The bill basically made a threshold where they were hoping that they could have this correction done. Like if you had the entire issue with this ERC, it would have been nice if they'd done this from Jump Street, right? Because a lot of businesses would have kept a lot of employees on. I know the PPP loan was designed to do that too, but if they could do both, I think a lot of businesses would have taken advantage of it. It's nice from a cash liquidity standpoint for sure for businesses that will qualify. And 2021 is really generous.
Right.
But my understanding is because of the January 31st deadline, that's these 941s are due for Q4. Most payroll companies are pretty reluctant to kind of try to correct it. They were hoping for an extension of that due date to like March 31st, which probably will not happen. So unfortunately, I think you're going to probably see a lot of amended 941s.
Yeah, I think you're right. I'm hoping that too, because what's funny is you can definitely, I spent a fair amount of time reading through this bill, more than I'd care to admit, and you can definitely tell that the language, a lot of it was written as if they were going to pass the bill much earlier than they did, right? And I think you're right. They were hoping that, look, by 12/31, all the guidance on this was going to be long since issued, and everyone was going to have a good understanding, right? That just didn't happen. So I agree. I think you're probably going to see a lot of amended 941s, which the payroll companies aren't going to be thrilled about. But and unfortunately,
for a fee.
I'm sure.
Right. Excellent. Well, we are coming up on 1 o'clock, so I will definitely be respectful of everyone's time, and we will close it at this point. But thank you once again to our speakers, Matt, Eric, and Manny, and Alex for putting this together. Should anybody have any questions on any of these topics, feel free to reach out to your primary Withum contact or visit our website at withum.com. And thank you all and have a great day.